Well, folks, welcome back to season 2 of the Profit Power Hour presented by Profit Coach. So great to have you joining us today for Small Business Economic Outlook, how to make labor pricing and M&A decisions in light of the current economy. We're really excited to have Greg Crabtree with us here today, and just hoping that you're going to get a ton of insight and information and in-depth understanding of how to make the best preparations for 2024 to make it your best year ever in light of some really in-depth small business economic information that Greg can bring to us today. So welcome to episode 9. So glad to have you joining us. Would love to hear where you're tuning in from. So if you could jump into chat and just let us know where you're tuning in from, and we'll get this conversation started. Also, as you have questions, be sure and put those in the Q&A box as we go along here, and we'll be sure to answer those questions as we go along. Greg Crabtree from CRI Simple Numbers is joining us today. Greg, thanks so much for being on today. Really appreciate it.
Yeah, thanks for having me. I always enjoy chatting with you guys.
Yeah, so for those of you who don't know Greg, he's the author of Simple Numbers, Straight Talk, Big Profits. He also wrote another book in the last several years called Simple Numbers 2.0, Smart Rules for Scaling Up. And Greg is a thought leader around making business finance understandable and actionable for small business entrepreneurs. And Greg's work has been significantly foundational for the work that we've done here at Profit Coach. Also, he was an advisor in producing the NARPM accounting standards, and tremendous thought leader when it comes to small business finance. So it's a huge privilege to have Greg on today. Of course, you guys know me. I'm the author of the NARPM accounting standards, CEO at Profit Coach, and we help PMs expand their entrepreneurial freedom by building highly profitable, self-managing companies. When we were on last month, I told you guys that I wasn't sure if I was going to be able to have the webinar because my wife was due with our 4th child. Well, literally hours after we had our Profit Power Hour last month, my wife went into labor. And so I'm happy to tell you that Joseph Daniel did arrive safe and sound, and we're pretty tickled about having him with us now. All right. Again,
congratulations.
Yeah, thank you, Greg. If you have questions, dump those into the Q&A box, and great to have all of you joining. Ron from Portland, Michelle from Athens, Georgia, Ashley, thanks for the congrats, Kathy from Texas, Shelby coming in from San Diego, Chapin, good to see you also. Oh, you moved to Boise. I didn't think you were in Idaho, but anyways, all right. So we are talking about small business economic outlook, again, how to make labor pricing and M&A decisions in light of the new economy. And as always, the purpose of these webinars is to help facilitate a mindset transformation. I know Greg is certainly going to help us experience that today, help us move from financial fog to financial clarity, from gut-based decision-making to predictable forecasting based on real data that you can trust. Greg's going to bring some of that data to us today. And then ultimately from mediocrity and business happening to you, and ultimately transforming that experience to benchmark success where you happen to business. So we're going to dive in, and the broad context of this is one of the things Profit Coach does and does well is help you understand what has happened in the industry. And we've talked about this as part of the financial benchmark study that we produced last year. A major shift has occurred in property management financial performance. We've talked about how the 6 games of financial performance have transformed and ultimately resulted in a significant profitability shift in this industry, where average profitability has gone from 6% in 2017 all the way up to 11% in 2021, and the top 25% of performers have experienced this shift from 25% margins up to 32% profit margins. And Greg, you can tell us, like, that's good stuff, but the question is that going to continue? What's the outlook? How do we make decisions in the areas of labor pricing and M&A in light of what's coming? So that's what Greg is going to dive into with us today. And to get the conversation started, I just want to throw up a poll to get some perspective from the audience on your economic outlook and how is your economic outlook impacting your business strategy? This is a multiple choice question, so you can select all that apply. So I just put that poll up there. Go ahead and jump in. How is your economic outlook impacting your business strategy? Again, you can select any that apply. There's no change in strategy. We're just running the same playbook. We're preparing for labor shortages and labor costs going up, or we're focused on increasing and creating efficiency in our company. We're focused on growth. We're actually staffing up for major growth ahead. We're raising prices to keep up with inflation. We're holding prices steady. So we'll get some feedback from the audience. But Greg, tell us a little bit about the work you've done in terms of
Mhm.
financial projections and economic outlook specifically for the small business sector.
Yeah, I mean, so some folks are maybe familiar, but just kind of to reset, our practice of simple numbers is a concept that we created when I had my own firm, and then now we've merged with Carr Riggs and Ingram, one of the top 20 U.S. accounting firms, and we're now a special practice unit, within CRI, that we have a singular way that we see an economic model. So that every client, regardless of industry, that looks at their P&L, if you compare it, with another simple numbers client, you're going to see it in exactly the same way, and you can talk exactly the same language. The big rocks that we uncovered in this process was, number one, revenue is a vain starting point for most businesses. Now, in the property management world, revenue and gross margin can be generally the same number, but some of you can get into management relationships where there is a cost of goods sold pass through that you're dealing with. And so we focus on gross margin, revenue minus any pass through cost that's before labor. That is the true economic top line of the business. So that's the first cornerstone that we lay. The second thing that we look at is labor relative to that gross margin. So that's our simplistic total labor efficiency ratio. The good news for all of you in the property management world is you guys have one of the most consistent standards that exist. And it's quite simply, you need $2 of gross margin for every dollar of labor, regardless of what that labor does in your property management business. And if there are clients in that industry that have struggled, it's generally where they get into ancillary activities that cause staffing needs, and they just can't get the requisite margin for the cost of that labor. So you get into construction management activities for the project. You get into sometimes maintenance activities, although maintenance activities for most of our clients have actually been extremely profitable, even more so than property management. But you got to be really good at managing it. You got to be able to get access to labor. But it creates a simplistic way that regardless of everything that you do, you just can think simply of $2 gross margin for every dollar of labor. I don't care about payroll taxes. I don't care about any other operating expenses. That 2-to-1 ratio, really works. And then it gives you a target to essentially create a natural salary cap for the business, just like an NFL franchise. There's a reason why all 32 NFL teams, pay exactly the same amount of wages, but there's a handful of teams that have a disproportionate frequency of making playoffs in the Super Bowl than others, and you want to be that team that wins. I'll give you another stat from the NFL, though. There's never been a Super Bowl winning team that had the highest paid quarterback on their team. So, and there's a reason for that. I mean, there's a natural salary cap for your business model. And if one or two people that don't produce relative to their pay suck up some of that compensation, you're going to struggle to be a successful business. And so your business works exactly like that. The market forces on us all roughly this salary cap concept. There's other industries, roughly 90% of the business models we see work off of this 2-to-1 standard. There's a handful of other industries, retail, distributors, union contract type businesses, or staffing business. Staffing businesses are on the low side, and the others, you have to get a little bit higher than a 2 LER. But the vast majority of businesses operate off of this two standard. But once you know your number, that becomes the number that you manage to. Now, it's interesting, Dana, you were showing your numbers from your survey, which I love. I mean, I really, really proud of you guys for doing the effort to produce data that gives people some context that is not, just kind of fluffy in the sense of how it was gathered.
Right.
I know the process you guys go through. You're like us. When we do data aggregation, we're applying some insight to it to make sure that it's
Yeah.
properly balanced and clean and it's properly categorized. I make a statement every time I do a talk that be careful of looking at industry data that's self-submitted. Anytime
Mhm.
people submit their own data that's not from the raw information, you've got to look at that information with a cautious eye, because most people just don't answer the questions correctly, and you get kind of results,
Right.
from it. But those of us that are touching the data, touching the raw information to then create the aggregation, I think we're the folks that create really insightful data, in that process. And so, you know, the fact that profit has gone up in your industry because of a couple of things. One, I think largely a lot of the work that you guys have done has really helped the industry understand the standard. I never started out to be considered an expert in property management profitability concepts, but after you do a couple of talks and you have a couple of clients in the industry, all of a sudden you attract things,
Yeah.
and I think our giving people standards. Once people, one of the phrases, I actually put this quote in both books. I said, "A man who aims at nothing hits it with amazing accuracy."
Hmm.
Well, once you have something to aim at, then people all of a sudden start to
Hmm.
act on it,
Hmm.
and so that certainly helps. The thing that worries me about the profitability benchmarks for the top performers and getting to that 25 and 30 and 32% is the fact that we went through a phase in the last couple of years during COVID of where there was a shortage of housing. You had a record high occupancy rates, record high increase in rents. And because of the payment mechanism that most property management companies work off of, is collecting your fee is a percentage of rents collected. Beware that you got a little bit of a gift of the market that might start to come back the other direction and bite you.
Hmm.
Because we're now starting to see in a couple of the markets some softness in occupancy rates. We're seeing some resistance to that next rent increase. And yet, all the while, more than likely, your costs are still continuing to
Hmm.
rise. We're still seeing
Hmm.
labor costs or people are still pushing for raises because their cost of living is going up. The government's calculation of inflation is just an absolute farce. But I'm okay with that because it gives them cover to not raise interest rates further. So I'm okay that they lie to themselves. And so that's fine. But just know that the real number, don't ever base any agreement that you have in your business off of CPI, Consumer Price Index, because that
Yeah.
that number is so grossly, off base of what reality is, and it's not even funny. But and the labor market has softened a bit in some markets, but in some markets, I mean, you can't find a living, breathing human. I mean, I live in Huntsville, Alabama. We have the tightest labor market. There was an article, we were listed as the best job market in the U.S. the other day, and we've got thousands of jobs of people that are high, six-figure jobs waiting for people to move to Huntsville that we don't have housing for.
Hmm.
Now, we've brought online a bunch of rental units that probably aren't going to attract those people to move, because these people want to buy a 750 to $1.5 million house that doesn't exist.
Hmm.
And the tract builders have stopped building the $400,000 houses because there's a mismatch of demand and capital resources being allocated. And so what we're facing now is this really dysfunctional mismatch of resources, demand, value, interest rates, and everybody's got to really look at your own market, and you've got to assess a couple of things. Number one is, what is the population of the moving in and more of the workforce population is what you're paying attention to. Those are the people that can pay the job, that pay the bills. I always ask this question, and just kind of think about it for the audience listening. How many of you truly know someone who's truly unemployed? Now, I'm not talking about this. You may know somebody that is looking for a job, but they're looking for that perfect job. I'm talking about a person that's truly unemployed, was willing to work to do anything to feed their family, but they can't find anybody to hire them. I I don't I don't know that person. Every talk I've given in the last 2 months, nobody's raised their hand. You
Mhm.
know, and that kind of, and that's I talk in a lot of places across the country, so it's a pretty broad swath of there's just not a lot of labor availability, but there is some. And this goes back into the rub that some of our clients are feeling right now is, um, you know their employees want raises, but our data is showing that, or for a 100 company model that we use to track our data, we're showing a decline for the first time since I've been tracking since 2013. This is the first time we've seen a rolling 12 decline in revenue from the 100 companies, and that decline has been happening, since last October. So let me actually share my screen and I'll show you here. And so this is the come on, yeah. So this graph here, the blue line represents rolling 12 revenues, about 1.2 to
Greg,
1.1 to
these are
1.
100 companies that you have access to for
Yeah,
small business. And so the point there is that this is a relevant data set, probably more relevant
yeah,
than a lot
yeah.
of the stuff you're going to get on,
This is a pretty clean picture of the true, what I call the working economy.
yeah.
Because, you know, the thing is, we've become a private company dominant economy. I heard a stat the other day. It was the first time I'd heard a number I could hang my hat on, but they said 60% of the U.S. GDP is made up of privately held businesses. Yeah, and I don't know where they got that number from, but it sounds right. It probably may even be a slightly low. I mean, we are just not a public company dominated economy anymore. And so even the public companies, we are the thing that makes them work. They hire us to do stuff for
Mhm,
them because they don't do it anymore. So
mhm,
if you really look at who actually does stuff, it's the people on this call. It's my clients who do everything that are the private companies. And so we selected 100 of them. It, averages about 11 to 12 million dollars of revenue, but some are above it, some are below it. But we track it and look at these trends. And like I said, the overall model is about 1.2 billion of revenue, which it's pretty decent data set. I'm not going to, sit here and tell you that I'm the world's greatest statistician. I mean, I'm a kid that grew up on a chicken farm in Alabama. So what do I know? But I've watched this thing for since 2013 was my first year that we put the data set together. And I'll tell you, I mean, this thing has been pretty doggone accurate of telling us the trends. And when we look at rolling 12 data, rolling 12 is every data point represents the 12 months from that point back.
mhm.
And rolling 12 data, which I know you know a lot about in your work, is rolling 12 is the highest form of economic truth. It's got all 12 months, all 4 quarters, all 4 seasons, every holiday, every dog ate my homework excuse. And what that data is telling us is we started peaking right here in about October of 22. And so once the marketplace realized that interest rates weren't turning around and coming down anytime soon, once the Fed started increasing, the market really paused and stepped back. But look at what labor did. So labor's on the right axis and revenues on the left axis, puts the two in correlation to each other. And you can see that labor has now separated from revenue, and this is crushing profitability. This yellow line down here is dollars of profit. We haven't seen an increase in dollars of profit in 25 months now. That is stunning. I mean, and that is companies' inability to correct pricing, get labor resources, have consistent throughput. You start, you stop, you pause. If you're a project oriented business, you sell the work. Yeah, I got the work sold. I just can't get it done. Customer calls it, hey, we need to delay that for a month. Well, your costs don't delay. You know, you're carrying that overhead. And so a lot of that dysfunction is still continuing in a lot of places. And for the most part, I'll show a graph here that is really kind of to the point. So in our world of operating expenses, what some people call overhead, we like the term operating expenses. This is the year-over-year rolling 12 change. And notice the inflection point of the decline was actually March of 22. And since March of 22, pretty much every one of these, your facilities cost, your management labor, payroll taxes and benefits, other OPEX, and marketing spend have gone down. And you can argue, should it, should not. I mean, you can see marketing expense has gone down dramatically because we've had clients that demand was not their problem. They have things to do. They just can't get the labor to do it. Or they were spending money on marketing, like my clients in the real estate sector and the mortgage generation sector. There's no real estate to buy and there's no mortgages to create. Yeah, and so they've cut their marketing spend dramatically. Other clients, it's the old adage of, half of my marketing works and half of it doesn't. I just don't know which half is which. And we've done a lot of work of late with clients, really helping them kind of dig into, the intuitive sense of what marketing, may be working and what doesn't. And sometimes you actually kind of get into this discussion of in marketing spend testing, you've got two options. I can surge a spend and sit back and see what changed. I can also turn off a spend and see what changed. And obviously in a soft market, people have a tendency to turn off a spend and test it. And what we're finding is a vast majority of people are turning off marketing spend and not seeing anything change. Now, I'm not advocating continuing to not spend money on marketing because it is a lifeblood. I'm just advocating you got to sharpen your focus and your intention and redeploy that spend on something that does work. Now, if you're in a market where there's just no response, save your powder for another day. But mostly, I mean, for the property managers, I mean, residential real estate, whether it's multifamily or even single family, residences, I mean, those markets are generally pretty good shape, but some of our clients have lost work because projects sold, and so they lose that management of that project, and because most of the new projects have been, if they weren't funded, they've stopped most of the new projects in most markets, right now, waiting for either interest rates to come back down or capital's got to step up and put a much bigger bite of capital money down to make the project work economically. Because you can't make it cash flow effectively, when you're looking at, either from 7 to 9% interest, depending on what kind of interest rate structure, your deal you're trying to put through, so. And the other thing is because money is drawing interest income at a decent rate of 5 to 6%, 6.5%, maybe in some cases, depending on term, it is sucking some of that cash that was aggressively dumping into the real estate rental market that now says, well, gee, I can just make interest income with a lot less risk, and that's close enough, and I'll wait for an opportunity to kind of see things go. And so really with those trends, I think every marketplace has to look at their their circumstances. I mean, the two markets that I've heard from people we know in those markets, Boise is probably a little overbuilt, and they're having some vacancy in the Boise rental market. Phoenix is got some softness in their rental market, but most other markets seem to be okay in terms of residential rental, but then single family rental seems to be still pretty solid all over.
You see that softening potentially, Greg? I mean, most of the people on this call are managing single family homes.
I mean, if you're, I don't think so, because I was talking to a single family, investor this morning, and he said one of the things that really has struck him is he's seeing a significant amount of people in his single family tenants be divorced families, and mostly whichever spouse has gotten divorced, that has primary custody of the kids, that he's seen just a market rise in how many of those, that profile of his renter has seemed to change over the last 3 or 4 years that he's been doing this. And I think there is a little bit of that society shift that's going through, because typically a lot of folks with kids just want that single family house versus an apartment. And the lack of availability of a house to buy, even though your rent might be roughly equivalent to what you can pay for a mortgage payment on that house, your circumstances are disrupted enough that you're just not ready to put down roots.
Right.
And I think that trend is going to continue. And certainly, I mean, there's been big corporate investors make big moves, especially down in Florida. One of my real estate clients down there is a sod farm, and so they kind of get their insights from kind of what's going on in the Florida residential market, and they do see a lot of corporate purchases of single family residences down there, taking big positions. Now I think some of that has slowed given the interest rates of the market, and and really, I mean, I think a lot of it's going to be what I would tell your folks to look for is something needs to create a catalyst to create transaction flow. Right now, we almost have a liquidity crisis in residential real estate, whether it's rental or to own, because the people who have the low rate mortgages can't give it up because they would be trading down to the next house. But even then, they just don't have options to buy the next house because it's not on market. I mean, my real estate client in Charleston, he said that there are just no houses to buy. I mean, literally, this is our discussion last month when we talked. It says, well, there's only 3 people that are creating a house to buy: somebody who gets divorced, somebody who dies, or somebody that needs to move.
Mm-hmm.
But outside of that, that's the only 3 circumstances that's creating a house, for somebody to buy. And, it sounds morbid, but you're going to try to talk to the estate attorneys and talk to the divorce lawyers, to kind of find out where's your next available house to list. Or the same thing as a real estate investor for rental property, same kind of thing. That's who you'd want to look to say, hey, I'm going to make a cash offer on your house so I can I can rent it to somebody. Well, sounds sad, but I mean, that's kind of where the market is at the moment. And I don't know the full answer to this, but somebody asked me the other day, well, why is there a housing shortage? Because it's, but there's just so many houses that go offline every year that, even though we have a flat population in the US, which is a bigger long-term issue, as you look down the road, but as we have a flat to declining population, why is if we're building houses, why are there's a shortage? Well, there are, real estate doesn't last forever. I mean, there's, neighborhoods that get blighted, and people migrate out, and those things. There's properties that get demolished and repurposed and all those kind of things. And so when you look at net units, I don't know that we've increased truly the net number of doors, but I can't speak authoritatively on that, but that seems to be the sense of it.
So Greg, taking this data, and I don't know if there are any other slides that you want to share.
No, I mean, that's the 3 main ones I wanted to cover.
Did you hit, was there a third one there?
Well, the second one, this was just a shorter term graph of the rolling 3.
Got it.
You can see now, typically we have an uptick, coming out of the winter, and certainly we are on an uptick, but that's just kind of the natural summer of it. And we're still struggling that, as you can see, when we have these dips, labor doesn't dip with it like it used to.
Yeah.
And so we've become a very labor inflexible marketplace. And so one of the trends that we see, we got a couple of clients that truly do create that culture environment that they want to hold on their employees long term, and they are successful in holding on to employees long term. The problem is those people keep getting raises and almost get to the point that they're above market because of their raises, and they just, no matter how much you like them, they cannot produce enough margin for what you're paying them. And we are seeing a trend. The most common trend in labor at the moment is where people are letting go their most expensive people and resetting with less expensive labor, even though customer service and capability takes a hit,
Hmm.
because economically their model just doesn't work to
Hmm.
keep going. They're kind of, growing their way out of business, but they just get less, and you can see that's this line right here. That profitability just keeps getting worse and worse and worse. That's because I keep paying more and more dollars and I keep getting less and less for it. So
Hmm.
unless I can price that into the market, I eventually have to change my labor mix.
Hmm. So
And that,
Greg, just in summary, in terms of property management specifically, what I'm hearing you
mhm,
saying is, yeah, there is a softening in some markets. Don't necessarily expect to see the same kind of increase in rents. But in
mhm.
general, what I'm hearing you saying at the same time is that you don't really, I mean, people are going to continue to rent. And so I guess my question for you would be, like, what is your overall outlook for property management specifically? And then based off of that, let's talk a little bit about
Yeah.
hiring, labor strategies, pricing strategies for the people on this call going forward.
Well, a couple of things. I mean, one is, yeah, the demand for your services will generally be pretty strong,
Yeah.
but there is motivation of multiple property owners that we've seen a move in some of our property management clients that lost business because they took it in house. And
Yeah.
so one of the moves is they count the beans and they say, you charge me more than what I can hire people to do it internally. Now they tell
Mm-hmm.
themselves that, it's not, it ultimately won't be true,
Mm-hmm.
but they're going to tell themselves that story. So
Mm-hmm.
number one, you've got to really be on your game, to be able to combat that the best you can. And sometimes there's no matter how good you are, you can't combat it. Because here's the thing, your your clients that you're managing the property for are struggling to get the returns on their properties that they were once getting.
Mm-hmm.
So they've gotten fat and happy off of super low occupancy rates over the last 3 years. And as you start to see some softness, I mean, just a percentage point or two, that that goes straight to the bottom line in return on
Mm-hmm.
the property. And then if any of them have variable rate mortgages that are being repriced right now, all of a sudden you're going to see properties that flip to being not cash flow positive because of rate adjustments.
Mm-hmm.
And so you've got to be really mindful. If you can find out, you got to be aware of who in your portfolio that you're managing have bad rate adjustment, circumstances that are about to come up again.
Mm-hmm.
And you just got to be prepared to mitigate, how you're helping them through it. And sometimes it's you're going to have to help them push through price increases. But there's no matter what you do that's really good stuff, there's going to be downward pressure on them wanting you to take less money.
Mm-hmm.
And guess what? I mean, that's just the crucible of business. And my tendency is, hey, if you're really good at what you do, I'd rather be smaller and profitable than bigger and unprofitable.
Yeah.
And so far, every client that we push to raise prices, on what they do, they've had a better positive economic outcome. Nobody's had a negative one yet. But there is a point that the market says, I don't care how good you are, that's just too much. And nobody knows where that line is. I mean,
Mm-hmm.
that's a scary place, to be. So you just got to really, really know your competitive markers, for your business, and you got to push to be on the upper end. Um, but you're going to see some of your customers go for who's cheaper, even though they're going to get worse performance, but in their mind they save money.
Yeah.
And when that interest cost that they can't control, they can't do anything about that interest cost. Once that sucker goes up, I mean, they're going to stretch maintenance budgets. They're going to stretch capital improvement budgets, and they're going to try to push your fee, structure down, in that process.
Let's talk a little bit about labor strategies here. And you alluded to this
Hmm.
a little bit, but I'm just going to throw up the poll results that we had from the poll at the beginning.
Hmm.
In terms of how is people's economic outlook impacting business strategy. No change in strategy, 7%. We're preparing for labor shortages and labor costs going up 7%. So that's interesting.
Mm-hmm.
64% are focused on creating efficiency in their company. So that's probably a response to labor.
Mm-hmm. Right.
Then 64% are also focused on growth. 23% say they're staffing up for major growth ahead. And then 30% say they're raising prices. 13% say they're holding prices steady. So I think, looking at this, the major focus is people are still optimistic about growth,
Right.
but they are also focusing on efficiency at the same time. So
Well,
your
if you're
thoughts on how today's economy should impact, and particularly in property management, labor decisions.
well, if you're if you're if you focused on growth, there's a big swath there. 64% are focused on growth. I'm going to challenge you and say, where's it going to come from? Now, if you know where it's going to come from, great. Because let me give you two opposing stories. First, in last December, had two fairly large clients. Both said they expected to grow 20% this year. Now, I was already looking at data then, as you know, that said, hey guys, we got some headwinds coming. We're not going to see an expanding economy going forward because when you don't have excess labor, there is nothing to propel the economy forward. So I just want everybody to get that through your head now. When there's no more labor, there is no expansion of the economy. And you can say, well, there's AI. Well, AI isn't a consumer. It doesn't buy anything. Yeah, it might help you get something done, but you know, the thing is, think of all of the technology and advancements in technology in the last 20 years. And guess what? Business models look exactly the same today as they did 20 years ago. Gross margin relative to labor.
Hmm.
I mean, the market adjusts to what is the cost of labor, what is the output of margin that has to go to cover it. And you can get away with excess margin for a little while on your labor, but the market competes you back. And these are just the laws of business, that you can't get away from. And so I had one client that said, we're going to grow 20%. And I kind of laughed and I said, and how do you expect to do that? He says, well, we already have clients, new customers that are coming to us that their suppliers are failing them. And we are picking up, we've already got known identified business that we're going to pick up. Now, they know that in their market, it's not expanding. And so they know that 20% growth this year won't recur next year
Right.
because they've now set a new period. But each of those accounts aren't growing. They're
Mhm.
just winning. So this is kind of economic Darwinism. The law of the fittest are surviving, and those other companies are failing.
Mhm.
And you're going to see this happen. You're going to in this your industry is not immune to this. You're going to see your weakest competitors abjectly fail at what they're doing
Mhm.
because especially the ones that have a high concentration of one or two customers, and if they lose those, all of a sudden they implode as a business. They cannot adapt. So that's going to happen in this industry as well. The second one, that I said, well, how are you going to grow? These guys actually did a maintenance component on exteriors of commercial and residential multifamily properties. And they said, oh, we're going to hire 15 new salespeople, and then we're just going to go out and sell and push growth. And I said, really? I don't see that. And so now we're 9 months into their sales year, and they're about to fire 15 salespeople. That actually they've gone backwards by 20% rather than forwards by 20%.
Mhm.
And so, I mean, you've got to assess the market of what's possible. I mean, it's great. You can have all the bravado in the world and throw out there that I'm going to grow 20% or whatever the number is. And I'm all for that if you know where it's coming from.
Mhm. Mhm.
But you can't manufacture it out of thin air. Just go talk to a residential real estate broker right now and ask them where their 20% growth is going to come from.
Mhm.
And it's like they have no clue because until
Mhm.
something changes and there's more houses available on the market, they're not going to grow. Go talk to a mortgage lender. They're going to go have no. I mean, they've laid off people to get down to just the mortgages that are dribbling over the finish line that have to be done, and they're hanging on until the market comes back. And so it's it's one of those things that you just have to look at and be honest in that assessment. And if you find that opportunity to do it, count yourself fortunate and go for it. Absolutely. But I think the the last 20 years we've lived in what I call the participation trophy economy. I mean, the economy was expanding so rapidly, you could be bad at what you do and still grow and be profitable.
Mhm.
And now we're in what I call the street fight economy. I mean, for you to grow, you got to take it away from somebody else.
Mhm.
And is that, are you ready for that fight?
Mhm.
Because that's what you got to do. You got to be better than the other person, and you got to, and not just be better, you got to go get it from them.
Mhm.
And it might force you to do things to grow your business that you never thought about doing before. But okay, if you're ready to sign up for that, go for it. Because what you're going to see is industries where if you had 20 competitors previously, it's going to shrink down to 10.
Mhm.
And now those 10 that survive, they're going to be a better business than they were when they were 20. That's good, in a sense. But that's what we're dealing with, pretty much, across the board with very few exceptions.
Greg, can you talk a little bit about like what you would consider to be, for the street fight economy, safe bumpers? Do you think that 2.0 LER is a safe bumper? What's your thought on that?
Well, I mean, our mantra, right now is called get profitable with what you got. I mean, so if you are seeing some weakness in your business, you got to, trim back and reset and be profitable with what you have and then grow back from there. I mean, in terms of labor efficiency ratio, I mean, you probably can live, I mean, two's the standard. I mean, you can do okay at 1.9. Now, when you start getting to 1.8, warning, hey, we've got to do something to fix this. And so you can use it. We've always said, 1.9 to 2.1 is kind of the safe zone. But, and so I would say if you get below 1.9, you better have a plan of attack to either quickly grow yourself back into it if you can see it coming. But if you have no idea where it's coming from or all that, then we're more into, hey, I gotta trim cost. I mean, I had a client this morning that, great culture business, but they've been on a labor wage freeze, for the last year, in their business, and their people are wanting raises, and they're going, we don't have any profit to give you raises with. We're hoping to get, they had a couple of big customer concentrations that, as those customers, kind of, fortunes waned a bit, everybody had to kind of suck it up, and hang in there with it. But there again, I think you've also got to be careful. I told you before the call that, one of the common trends we're seeing in labor management right now is as your senior people become the most expensive, they're struggling to produce enough to justify that wage.
Hmm.
And so, we're seeing a greater trend of people letting the most expensive people go, resetting with the less expensive people, and just living with the result of that. And I know that's not elegant, that's not pretty, it's not easy. There's all kinds of bad to it, but it sure beats going out of business.
Yeah.
And you know, so I mean, those are the tough calls. And once again, this is where you get to shine as an entrepreneur. You got to be really good at flushing out the best talent at the right value.
Mhm.
And so I can get the most out of somebody who's a very valuable, person, but I just can't keep paying them more and more and more and more because we're starting to feel that resistance of, we just can't pass through every price increase, although, we're still going to push you to try it, test it, and until you get resistance back and lose business or don't get any more. I mean, you're probably leaving some money on the table. But some of our construction clients, I mean, they're seeing it in some of their bids. They're missing, there's some construction bids that are going out that this is the first one of the early signs of weakness is when construction companies are bidding to cover overhead.
Mhm.
And that it's a death move, but people do it. And that's a sign that the construction industry is starting to finally feel the pinch. Now they've been propped up by, as the private money market kind of pulled out of real estate spend, the public sector dumped a bunch of money in. So right now, about 60% from what I've heard of construction, especially commercial construction, is public funded construction. And so if any of that money starts to moderate, that's been keeping a lot of the construction companies active, but because the private money is still largely sitting on the sideline.
Greg, I want to talk a little bit about AI and how companies, small businesses should be thinking about that relative to their labor model. I also want to talk a little bit about mergers and acquisitions. You mentioned a moment ago, like, hey, if you had 20 competitors, you're only going to have 10. There's some opportunity there for somebody. So I want to come back to that in just a moment. But before we do that, folks, I just want to give you some action steps where you can get some clear insight on what this means for you in terms of your preparations for 2024. Right now, we've entered the slow season in property management, at least for most property managers. Leasing season is past, and the next 6 months are really going to define how successful you can be in your growth strategy, in your labor strategy, and your pricing strategies in 2024. So as always, I want to encourage you to get the NARPM Financial Performance Guide as a point of reference on what's possible. And of course, we encourage you to get converted to the NARPM accounting standards. But I talked with our coaching team this morning, and we want to offer something that we haven't done before. And that is help you answer this question: how are you preparing now to make 2024 your best year ever? What you do over the next several months in terms of strategic shifts with labor, pricing, and growth is going to define a lot of what 2024 looks like for you. So we'd like to invite you to schedule a 2024 financial pre-planning session with our coaching team. No cost. Help you better understand your greatest threats and opportunities in 2024, discover your profit potential for 2024, and get help identifying the top 1 to 3 slow season initiatives, development initiatives that you need in your business to make 2024 your best year ever. So how this works, we do it from a numbers perspective. Send us your P&L. It's always the key starting point. And then on this call, we will help you better understand your greatest threats, discover those, what the potential is for 2024, and then help you get clarity on identifying those 1 to 3 initiatives. That's the key here that you need to be focusing on in 2024. So no strings attached. That would be helpful. Just say yes to the poll here, and we'd be happy to jump on a call and schedule that with you and get you that clarity on what 2024 is going to look like. I'm going to throw that poll up in just a moment. But Greg, let's talk a little bit about AI and the impact of AI on labor. Is that a relevant discussion? What should small businesses be doing in relationship to AI?
Well, I mean, I would proceed carefully. I think, we've seen the biggest utilization of AI in the realm of content creation. And I will give you some warning there. I see a lot of AI generated content, and I would consider it relatively soulless and non-impactful. It looks great, but it doesn't have the same emotive value. Now, some people are able to pull it off, and so I would think most of the best professionals in the content creation world would tell you, it's great for ideation and first draft and those kind of things, but you really, really, really still have to have a human edit it and deal with it, and do those things. I think, you got to be really careful that I just think there's still way too many circumstances where AI runs amok. And if you really turn it loose with the keys to do some repetitive task, it sometimes has a tendency to change its own rules. So I think it'll get there, probably just about in time to kill us. So I would probably tell you, just proceed with caution, use it as augmentation, but do not take the human control, out of it, because I just think there's a lot more issues at play than people are realizing, and also be careful with what you put in there, because you got to understand there's times that you're dealing with AI that everything you use it for is going into the hive and becoming public part of the knowledge base, and there's times that you need to control private data and things and keep it disconnected and have AI act on it, but not pull it back. Who knows if they're telling us the truth of whether or not they are keeping that private or not. I don't know that I trust them enough. So I would be more. I know that sounds cool, and there's a lot of great stuff that people said, oh wow, that it's got a lot of oh wow feature to it. I haven't seen a client yet that has had a massive improvement because of it.
Mm-hmm.
Now, not to say that it won't happen,
Mm-hmm.
but I just use it where it makes sense, and just be careful of trying to apply it and keep controls on it. Would be my thoughts.
Talk a little bit about M&A and
Mm.
are we moving into a buyer's market or a seller's market, and how can we tell?
Well, it's definitely a buyer's market. I mean, all multiples of every deal. A lot of deals have fallen through for companies that were in the process of an M&A that was debt, some partially debt funded.
Yeah.
Anything that was partially debt funded that didn't have committed interest rates already lined up. Those deals have started falling apart, since then, and either got renegotiated or just pulled back completely. So now doesn't mean there's no deals going forward, but you can expect 1 to 2 multiples less than what was being offered in the past, and certainly, the deals that are getting done right now are far more built around strategic deals where somebody's coming to the table with all cash. They've raised a fund. They don't need any debt, and they're making more of a long-term play. What's gone in the market are the debt-backed flippers that are and this isn't new. I mean, we've had, roll-ups to roll up and flip have been around, since the dawn of mankind. And so we're just in a cycle where the roll-ups for the quick flip that were debt backed, have kind of bombed out now.
Okay. That's really insightful. That's really helpful for our
Yeah.
space. I think maybe we're a little bit behind what you're describing there. I mean, the deal with the highest multiple I've ever seen in property management just happened 2 months ago. And so that being said, I think that there has been, over the last 2 or 3 years, a significant increase in roll-up plays that has driven those multiples up. But what I hear you saying is
right, but all right, so
right around the corner
take
from that turning around.
take roll-ups though have to be put in 2 camps though.
Yeah.
There's the roll-up that I'm rolling up to then flip it, and
Yeah.
it's the versus the roll-up that is a strategic
Yes.
to then roll up and operate.
Yeah.
And so, my sense would be the deal you're talking about probably was a strategic
Yes.
roll up to
Yep.
continue operating for the foreseeable future, not for a quick exit.
But as those debt back flippers come out of the market,
Mm-hmm.
what I think you're saying we're going to see is a softening in those multiples.
That's right.
And
Absolutely.
For the smaller businesses on this call today, would you say there's probably, with the labor pressure that we foresee, more opportunities for small acquisitions coming up?
I mean, there's always opportunities, and like I said, I mean, there's still plenty of money out in the marketplace. It just depends on, I think most of the M&A guys are saying the money is kind of taking a step back, and they're reassessing the landscape of what they want to play in. And certainly,
I was referring to small businesses on this call being able to make small acquisitions as a result of the tightening up of,
there might be,
Yeah.
that's just kind of a, keep your eyes open, have cups of coffee with people, and you just never know. I mean, there's certainly been a few people that, when somebody loses, a key, key customer or two that was high concentration, there might be something left for you to just take over. And we've seen a couple of those in different industries. I'm not seeing one in your industry, lately, but it's something to keep an eye on. I just don't know that. I mean, a lot of times you're going to look at it and say, why would I buy it when those people might just actually come to me without buying it? And so, you know,
Hmm.
that tends to be, you know, when a company kind of implodes, you know, to step in and buy it, I don't know what you're buying,
Yeah.
you know, from that standpoint sometimes.
Yeah. I see what you're saying. In
Yep.
this case, it would be, management contracts.
Right.
So Greg, as we wrap up here, and I know you got a hard stop at the top of the
Yep.
hour, so I have one final
Hmm.
question. All right, it's September, as I mentioned. This is the season of the year where things slow down. People have the opportunity to focus on strategic initiatives in their business, whether that's, in a variety of areas, growth, pricing, labor. What would you, efficiency, what would you encourage the focus of how can people think about what they should be focusing on over the next 3 to 6 months in order to make 2024 as best as possible?
I mean, you know, I think right now it's a focus on the fundamentals. Got to get profitable with what you got. Got to make sure you're fully capitalized, and build up maybe a little extra cash fund. Like you said, if you might find an acquisition that you can throw a little money at it and do an earnout, you know, and do that with some you know, unwind provisions or kickers where if things don't happen the way you expect, you know, you can do that. So those are things I would probably more focus on. But I think a lot of it is in the getting profitable what you got. I mean, that's really probably going to take up the mass uh, amount of your focus time to get that right balance of labor on your team and the cost, the skill set and the cost of that skill set relative to the management fee income, you know, that they're helping you produce. And, you know, and that's going to be the big challenge. And, you know, and certainly go through, I would say in terms of um, this year's annual planning, I would be particularly focused on threat assessments. You know, I would do a pretty hard look at, you know, what are the threats that haven't happened yet, but
Mhm.
don't be blind to them of what, you know, be cautiously paranoid, you know,
Mhm.
of what could happen. And you know, and if you can't do anything about it, you know, go back to sleep and don't worry about it. You know, if you can do something about it, okay, then have an action plan.
Mhm.
And don't fret over you know, if China invades Taiwan, can I die? Can I stop that? Can I, you know, do anything about it? No. I mean, I will just deal, you know, with the outcome. It certainly looks like that's probably not likely based on, you know, some of the people, you know, that I follow. But it could happen. Even they admit that it could happen. And so there's global thing, you know, there could be another, you know, COVID type virus, you know, that shuts it down. No, none of us saw COVID coming, although I have noticed that in a lot of the TV shows leading up to COVID, there's been multiple TV shows that had a COVID like virus in the plot of the show. So it actually was in people's thinking to some degree. It's just the general public just didn't believe it was ever going to happen, you know, and it's like, you know, I prepare for those things? Nah, you know, I mean, just kind of be steady, you know, you know, eat your vegetables and do the fundamentals. And if you're that, you're going to be the company that comes out on top because, you know, 80% of the companies are not living by those fundamentals.
Yeah.
And that's going to be your secret sauce to thrive in a disruptive economy. But don't lie to yourself. You just got to get out of your mind that the economy is forever growing. The
Mhm.
dollars may go up, but the actual quantity of activity is flat to declining.
Mhm.
And until you have an expanding population, you cannot have an expanding economy. So just simple as that.
Awesome, Greg. Thank you so much. I really
Yep.
appreciate you tuning in from the Hilton Hotel in
Yep.
downtown
Yep.
Dallas, I think you said.
Yep.
And
Oh, Houston.
Houston.
Yeah. Yeah.
Appreciate the insight very much. And folks, hey, Greg, can you share those slides with me so that I can
Uh,
pass those out?
yeah. I'll cut those out, and it's part of a bigger
Yeah.
presentation.
If
But
you wouldn't mind
I'll
sending
shoot
me
those
those
to
three
you
slides
afterwards.
so we can set it out, that'd be great.
All right. Sounds good.
All right. Take care, everybody. Have a great rest of your day. And we
All
look
right.
forward to connecting with you.
All right. See you. Bye bye.